As the world continues to reel from the economic impacts of the pandemic, experts are issuing ominous warnings about the state of the housing market. With property values crashing harder than during the 2008 financial crisis, many are bracing for a potential housing market meltdown. What does this mean for homeowners, renters, and prospective buyers? And how can we brace ourselves for what may be a rocky road ahead? As mortgage rates rise, making homes less affordable for buyers across the country, the housing market in the United States is in crisis. According to statistics compiled by Redfin, the total worth of American houses has dropped by $2.3 trillion over the past 8 months. The situation is so dire that even Federal Reserve officials predict a 10% decline in house values and admit that bubble theories were correct. Moreover, mortgage applications have recently reached a low not seen since 1995, coinciding with a sharp decline in home sales. An expert who correctly forecasted earlier downturns says that many properties will lose half their worth by the end of 2023. A surge of bankruptcies is now appearing on the horizon, warning signs that more upheaval is coming. To get deeper into the insights, watch this video to the end. The video will explain the cause of the upcoming housing market crisis and what you should look for and expect, as well as give practical advice on how to protect yourself from this impending crisis. So let's take a step back and look at the big picture to understand better what's coming, who will be affected, and how to prepare for it. The U.S. housing market has not seen such an inflated and unstable state since 2008, when the real estate bubble burst, creating a domino effect of disastrous financial implications. The destruction of home values, which had been rising sharply at one point, resulted in an economic crash that plunged the world into a far more severe recession than the Great Depression. Homeowners were hit particularly hard by this situation as they saw their investments vanish overnight. This caused many people to become homeless or go into deep debt, wiping out much of the wealth accumulated over generations for some families. It was not just individuals who suffered. Businesses large and small also felt the impact as credit markets tightened up in response to the housing crisis, making it difficult for them to continue operating while they waited out the turbulence. The consequences were catastrophic on both local and global scales, with a lasting ripple effect still being felt today in some areas. Unfortunately, 2023 is facing the same situation. The experts agree that the current state of the housing market is a ticking time bomb waiting to blow. The recent summer of 2022 has seen a marked decline in the housing market, with a significant fall in home prices in some of the world's trendiest cities, including San Francisco, California, Boise, Idaho, and Austin, Texas. These cities had experienced an unprecedented boom in the housing market, which has now significantly weakened, resulting in an overall decline in the value of residential properties. This rapid decline has left many experts scratching their heads and trying to understand the extent of the damage. Based on data from the 20 largest metro cities, including the S&P Case-Shiller Price Index, industry professionals agree that the current market is neither favorable to sellers nor buyers. As a result, both purchasers and vendors in the U.S. real estate market are at odds right now as they attempt to determine whether or not values have bottomed out and whether or not they should resume construction. With no clear end in sight, the situation is becoming increasingly complex for those who wish to navigate the real estate market in the current climate. Experts speculate that this unrest and uncertainty may persist until a clear understanding of the market conditions is achieved, enabling buyers and sellers to find a stable middle ground. According to Moody's deputy chief economist, analytics costs have decreased globally, though this trend has not been consistent. He also mentioned that they dropped precipitously over the summer and again in January and February. This is because buyer and seller markets struggle to adapt to rising interest rates. The expert also pointed out that periods of rising jobless rates, like the present one, tend to be accompanied by sharper drops shortly. This indicates that people are withdrawing from the housing market in droves for both buying and selling. Please take a moment to hit that like and subscribe button if you are enjoying the video so far. Because of the rising cost of debts, house owners are less likely to put their properties on the market. They've secured a cheap interest rate for the duration of their mortgage, meaning their monthly payments won't increase unless they refinance or sell. The market would likely freeze at that time because of the significantly increased prices they would have to pay. Sales have dropped to a record low as purchasers back out since they can't make the payments every month, and sellers pull off considering they have no reason to sell. Logan Kane's analysis of data from Fannie Mae shows that mortgage application volume is a reliable early economic predictor of future sales volume. Mortgage application volume suggests that current house costs are discouraging potential buyers. The property market is still considerably overpriced across the United States, regardless of current price drops. If unemployment were to increase by 5%, home prices would have a much further decline. The market wasn't reacting to any severe economic disruptions at the time. Several debtors would be unable to keep up with their home payments. In addition, there is a rising tide of bankruptcies, which usually cause a steep drop in values. It's no surprise that Federal Reserve officials are alarmed about a further 10% price decrease. An economist at the Dallas Federal Reserve expressed concern that the U.S. housing market would experience a significant price adjustment this year and that further rate increases from the central bank could exacerbate a potential collapse. Due to the epidemic growth, the property market has become overheated since 2020. Despite indications of a slowing house price rise, a severe housing downturn is still possible. House price-to-rent ratios, which assess the viability of housing as a business chance, represent the current economic problem. Even in the most conservative baseline situation, property prices are expected to decline by more than 20% across the United States. The potential for a deeper price drop cannot be disregarded. Experts warned that the typical 30-year mortgage rate had risen to 6.5% from 3.89% the previous year at the same time. The potential for a chain reaction in which buyers flee the property market in search of stability and cash prompts worries about adverse effects on the U.S. economy. A survey compiled by the National Association of Realtors found that the price of an existing house in the middle range fell by 2% in February 2023. This is the first annual price drop since February 2012 and the first monthly drop since August 2011. Moreover, the organization observed that the decline was more pronounced in some areas than others. In both New York and Los Angeles, for example, the average cost of an already built house has dropped by 10%. In San Francisco, the loss was even more abrupt, dropping by a factor of 13. On the other hand, according to the National Association of Realtors chief economist Lawrence Young, prices have not yet bottomed out. As per his recent interview, we can anticipate a prolonged price decline throughout the remaining months of 2023. According to the National Association of Realtors, purchases fell by 42.4% year over year in the West, where the downturn was most noticeable. As a result, many worry that we're headed for another property market collapse like 2008. According to a recent poll conducted by National House Service, 53% of potential house buyers are concerned that the housing industry will fall apart this year. It's essential to remember that the typical American middle-class family has more than 70% of their net worth invested in their home, making even small monthly losses potentially disastrous. Moreover, the home itself is one of their most valuable assets. If its value drops, their retirement nest egg will shrink, and the previous 8 months have seen the property market's largest decline in value since 2008. According to reports, the current jobless rate and the index's performance are remarkably identical to those seen in the run-up to and aftermath of the 2008 housing market breakdown and the subsequent global financial recession. Grantham, a market analyst, noted that the present boom is much larger in scale than the one in 2008 and called it pretty damn big. The property market in the United States could fall by about 29% if the chance is on America's side, but a 50% drop is undoubtedly possible if things go wrong. According to the bubble specialist, a severe economic catastrophe is unavoidable when this mega bubble bursts. When the stock market crashes, it inevitably drives down the bond market and the financial system. So the onset of yet another devastating economic catastrophe is much closer than you might imagine. But unfortunately, even though investors are freaking out and politicians are frantic, most people still don't know what they're getting into. According to Grantham, a considerable impetus for a super bubble is imminent, and its ramifications will be incredibly devastating. He stresses the urgency of preparing for the consequences that are inevitably bound to occur. Detailed analysis and research indicate that its effects will be far-reaching and may lead to unprecedented economic downturns. Therefore, individuals, governments, and businesses must take necessary measures to mitigate the impact of this super bubble. But how can we avoid getting caught in the market's meltdown? The most important thing is for investors to develop a long-term mindset and diversify their investments. Having an emergency fund and access to cash for weathering the storm is also essential. Finally, investors and the general public must remain informed about market conditions and relevant news. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video and leave a comment below, letting us know what you think about the current housing market outlook and what you think is the best way to protect your investments.